Morning, ladies and gents. My name is Simon Brown. I'm not quite sure how to follow that up, so I'll keep it simple, I suppose. Certainly I don't have the hot pink. This morning, shoes or shares, keeping it fairly simple as the day goes on. There'll be different presentations. I'll be back in the auditorium at 2 o'clock to redo it. What I really want to look at this morning is to keep it simple and to give some ideas around the stock market and how we can make it work and the like. Okay, it went dark. That's me. That's where you find me. One of the key things is, and it's a fact of life, it's a fact of who we are, and it's how we do things, is that we want to acquire things. We like things, whether it be shoes, and a whole lot of men in the audience here are saying it's not shoes, but then if it's not shoes, it's something. For me, it's camera equipment. I have a rule where I was not allowed to buy any camera equipment this year, and I kept it actually going really, really well until about yesterday sometime when I clicked on an Amazon link. The point being is that we want stuff in our life. Of course we do. It's quality of life. There is no point in saving like crazy and living like paupers at this point in the equation. But we need to get that balance right, and that's the critical component. And part of that balance is getting onto the JSE and creating wealth. This is where we invest. This is how we create wealth. Everybody wants to be richer than they are now. Even rich folks want to be richer than they are now. In truth, folks like Mahatma Gandhi and Mother Teresa wanted more money. The key distinction, of course, they wanted the money to give it away. We want the money to spend it for ourselves. But we want to create that wealth. We want to do it for our own selves. We want to do it for our retirement. We want to do it for our kids' education. We want to do it for a whole range of different things that will be unique to each individual. And that's where the stock market comes in. That is how we create wealth. There is no quick way of getting rich. Okay, there's one quick way of getting rich. Marry money. And for the young folks out there, that might work. For the folks like me who are already married, if you didn't marry money, we need to find some other alternative to doing it. It's not about coming to the stock market and being rich by Tuesday. Tea time, morning tea because you have plans for the afternoon. It's simply not going to happen. It is a process that we need to start as soon as possible, and it's a process that we're going to be doing for the rest of our lives. It's knowledge that we will impart to our children, our grandchildren, our nieces and nephews, etc., that they will use through the duration of their life as well. And it's about investing on the JSE. And what we're doing on the JSE is we are buying slices of businesses. So we can buy a slice of the Johannesburg Stock Exchange. That is a company listed on the JSE. We can own a slice of this building. Now, not a very big slice. And if you go out into the atrium out there, maybe a square centimeter of the flooring belongs to you. You can't take it home, but you can spit and polish it if you want. And that's what we're doing when we're investing. We're buying little slices of companies, and companies that we know, companies that we engage with in every day. And I'm going to come to that in more detail in a moment. The key point is it's not about rocket science. It's not about fancy degrees, having to be a CA or an accountant or have a BCom or a PhD or anything like that. Most of it is fairly common sense. The problem with common sense, it's not so common. And mostly because we abandon common sense at the altar of let's get rich and let's get rich real quick. That's the mistake we fall into. If we say let's get rich slowly, suddenly it becomes incredibly easy. So the first point is it's save then spend. The number of people who come to me in the presentations and webinars and stuff and say, well, I don't really have any money. And the problem is, what do we do every month? We spend our money, and at the end of the month we say, oh, we've got nothing left. It's about that mind shift. It's about changing how we think. And typically as human beings, we think very badly about money. We have very bad relationships with money. If we think of the cliches out there, if we think of the phrases that are thrown around money, they're all negative. Burn a hole in your pocket, a fool and his money soon parted, save for a rainy day. Why don't we save for a sunny day? So we've got to get our mindset right first, and that mindset is very much, it's about saving first. We need to put money aside for our future up front, and then we need to spend the rest of our money. And the sooner we inculcate that and get that into our thinking, the sooner it starts to happen. And it's about every single month. And it doesn't have to be huge amounts. Yes, there are people on the stock market. Christo Visa comes to mind. He is worth approximately 25 billion rand. He bought some shares the other week. He bought 100 million rands worth of shares. The equivalent would be me buying a cup of coffee. And pro rata. For him, 100 million is small change. For us, 100 million is, you know what, we never have to do a single thing for the rest of our life. We can go and buy an island. Heck, at this rate, we could probably buy Europe. Certainly, we could get Greece. But we can start from as little as 300 rand. And you're going to say, well, 300 rand isn't going to make me rich. Well, is 300 rand going to buy you a Greece? Probably. Is it going to buy you a real island? Probably not. But it's about starting. That's the critical component. It's about starting that process and about continuing it on and constantly always saving. And yes, 300 rand is small, but as things change, our life circumstances change, we get better jobs, we get salary increases, we can do more. We get children. Children are expensive. But one day they leave home. Or you change the locks, whichever comes first. So it's about that process, but it's about starting. That is what's critical. And why are we doing it? Because we want better life. We want wealth. And that's, for some people, it's a hammock on an island. For other people, it's to retire earlier. Or it's to retire with slightly better. The stats in South Africa, 94% of South Africans will not retire, or when they do retire, they will have to reduce their standard of living. The question is then simple. What do you give up in your retirement? 94%, which means it's pretty much everyone except for you six down there. The rest of you are giving up something in your retirement. What are you giving up? Look around your life right now and say, oh, that's cool. When I retire, I'll give that up. Understand further that at the age of 60, you have a 50% chance of making it to 90. So you've got 30 years of retirement and you've had to give up something. And that number's changing. The person who will live to be 150 is alive today. Probably not in this room. But certainly they are alive today. We're living longer. We need to take responsibility. And that's the beauty of the stock market, is that everybody can come to it with different requirements, different outcomes that they're looking for, and we can all interact and engage in the stock market with those different things that we are looking for. And for some, yes, it's a hammock on an island. For others, it's just a slightly better quality of retirement. For some, yeah, might be 1,000 shoes or whatever the case may be. There was a chap on TV the other night on that cooking show, 450 pairs of shoes. You realize that's a different pair every day for a year and a half. So why do we do it? Because if you're not looking after your future, sure as heck nobody else is. Nobody cares about your money as much as you do. Nobody cares about your future as much as you do. You have to take responsibility. That is absolutely the cornerstone. We have to be in charge of what we're doing, how we're doing it, and why we are doing it. Because sure as heck, yeah, somebody else might offer to do it, but they don't care about your future as much as you do. Of course they don't. Just as you don't care about somebody else's future as much as they do. Children, obviously, excluded. Your children, not necessarily somebody else's. So it's about taking control of that future, because if you're not, who is? And over the long term, shares are the best performing asset class. And I stress long term. And when I say long term, I am measuring in decades. When I say short term, I mean 3 to 5 years. Medium term, 5 to 10. Long term, decades. Different asset classes. And what do I mean by different asset classes? Property, gold, cash in the bank, etc., etc. will all have their day in the sun. For a while there in the early 2000s, best performing asset class, property. Back in 2008, best performing asset class, money in the bank. Because you were getting 15% interest and stock markets were collapsing. At times, it's been gold. But over the long term, what shakes out? Equities, shares, stocks. That is our best performing asset class. And there's a picture to illustrate it. This goes back to 1985 through to now. The stock market back in those days, the index, which is a representation of the market as a whole, which is a fancy way of saying the average. What I mean by the average, so yesterday our market went down 0.5%. What that means that of the stocks within the index, there are 40 in the top 40 index. Of those 40 shares, the average move was minus 0.5. Some stocks went up, ShopRite. They went up 1.5%. Some stocks went down 2 or 3, average move. That's what we're looking at there. And we can see, for example, the crash of 1987, which back then was 22% down in one day. Now that ruins your day. I was still in matric at that stage. I bought shares a week before. It wrecked my matric year. But if we look at it now, 20 plus 5 years later, it barely even measures a blip. We got the emerging market crisis of 98, we got the dot-com bust, and then we have the financial crisis of 2008, which in truth we're still living through. What we can see, and make no mistake, that was not a fun experience. I was working for Standard Bank on the trading floor at the time. That was a pretty rough year. But we're now above those levels. And those levels are actually taken from September. If we move forward to October, we're ever so slightly higher above those levels. What we care about, those day-to-day fluctuations can give you heart attacks. What we care about is the average. And the average is up. And the average is around 16.5% per year compounded. That's doubling your money every 4 years. That is create 4 years and some change for the folks out there who can do math in their head. About 4 years and 4 months, double your money. That creates wealth over time. That is critical. The time part is always most important. Where's my next slide? So I was saying earlier, what are we doing here? We're buying slices of companies. And these are companies we know. These are companies we engage with. And none of it, as I said, is rocket science. I mean, let's pick on the banks for a moment, because banks are always easy to pick on. Everybody has a bank account. No, that's not true. Everybody has more than one bank account. You have a current account. Maybe you've got a savings account, hopefully. A home loan, a car loan, and so the list goes on. Maybe you've got some investments with your banks. We're up to 5 already. You can carry on going. Every month, you get a statement from your bank and you see they're charging you fees, probably an inordinate amount of fees. You can't understand why it's that much money considering what they give you. You probably think they're ripping you off. Well, get a slice of the action. Buy a bank. Not the whole bank, because that's going to cost you 180 billion rand to buy a Standard Bank. But you can buy a slice of Standard Bank for 120 rand. You shop at ShopRite. Now, if you shop at ShopRite, you probably think the prices aren't bad, but you also realize that they're making a profit out of you. We'll get some of your expenditure back. Buy a slice of ShopRite shares. Again, not the whole company, that's 100 billion rand. But you can buy one share in ShopRite for about 160. That one share gives you a right to the profit that the company makes, pro rata. It gives you the right to attend the annual general meeting and vote on important issues. And if the share is popular and the price goes up, you will make profit from that increase in share price. What it doesn't give you is the right to not queue. You still have to queue at ShopRite. You still pay full price. And you cannot phone Whitey Basson on a Monday morning and say to him, hey, Mr. Basson, I was in your store on the weekend and I think you need to... No. He runs the business. You're a shareholder. But that's the beauty of it. Passive in the sense that you own a part of the business. You now have an asset that works for you. Every day of the week, 30,000 people get up and go to ShopRite to work for you, to make profit for you. Not just you and the other shareholders, but nonetheless, that's what they're doing. 7 days a week. Right now, there are people out there who are working at ShopRite to make profit for me as a shareholder in that company. And is ShopRite going to disappear overnight? No. None of these brands are likely to disappear in a hurry. Some of them are going to be more resilient. MTN happens to be in a space where technology is happening fast. Are they going to disappear? No, but technology changes. Companies like SAB Miller, that must be the easiest business in the world. I mean, think about it a moment. When times are good, we drink. When times are bad, We drink more. So it's the point. But not rocket science. These are brands we know. These are companies. We understand how they make their money. So how do we get to the stock market? You're in the JSE itself. This is the Johannesburg Stock Exchange. This is the building, but you need to go through an intermediary. You need to go through a stock broker. Otherwise, we would have to go stand in the corner of Greyston in Rivonia and knock on people's car windows and say, I've got some ShopRite shares, how much are you going to pay me? What do? We transact from anywhere in the world. We come to an electronic exchange, a central order book. We can do it DIY, online investing. There are a number of online stockbrokers here this morning, PSG, Vunani, Standard Bank, FNB and others. Very much like the internet banking, which we all know, understand and probably utilize. And that gives us full access to everything on the JSE. 420 shares, not just the big names that we know, but the future big names. And in truth, the future bankruptcies. Not every company, not every small company is going to become a big company. So we can do the DIY route. We can go via the asset managers. Those are the folks who typically drive fancy cars. Yeah, ask yourself who paid for the fancy car. And they would advise you as to what to buy, what to sell. They will make recommendations. They might even manage your money entirely. They'll take your money and say, come back next year, we'll tell you if you have profit. Some of them are good, some of them are not. Like anything, do your homework. If you want to give your money to an asset manager, do your homework first. And again, the homework is not rocket science. I'm going to touch on that, but we'll park that there for now. We can do unit trusts. Most of us understand the concept behind a unit trust. The big companies like Stanlib, Sanlam, Old Mutual, Liberty, Allan Gray, Coronation, etc. offer unit trusts. You buy the unit trust, that gives you exposure to shares on the JSE. Within a certain mandate, you will get general equity unit trusts. In other words, they invest in pretty much anything. You can get resource-based unit trusts. They invest in resource shares. You can get IT unit trusts. You can get money market unit trusts, and so the list goes on. Unit trusts are nice. Two problems: costs. And costs are critical. Every cent you pay in fees has disappeared from your retirement. But worse than just disappeared is that its potential growth has disappeared as well. $100 today in fees, if I had invested that, and I'm doubling it every 4 years, in 4 years it's 200, in 8 years it's 400, and you've taken out the growth from your future as well. Quick example, low cost investment at 1% versus a high cost investment at 3% over a 20-year period, growing 15%. The one investment is worth 800,000, the other one is worth 1.2 million. That difference, fees. That's all it is, fees. Somebody made that money. It wasn't you. Unit trusts often charge high fees. Again, do your homework, interrogate. And then we have something called exchange traded funds, which to my mind are approximately the best thing since, just the best thing. Sliced bread, yep, sliced breads are good. It's just the coolest thing. What do exchange traded funds do? Well, they're kind of like unit trusts. Two key distinctions. Low cost, very low cost, less than 1%. And further to that, instead of trying to beat the market, which is what a unit trust does, and attempting to beat the market comes with the risk of losing. I mean, technically, half of you can beat the market. From that lady there, that half beat, that half don't. That's just good old-fashioned common sense. Unit trusts do that. Well, only half the unit trusts are going to beat the market before costs. After costs, truth of the matter, 15% of unit trusts beat the market. So that corner down there. Exchange-traded funds match the market. And as I said to you, over the long term, best performing asset class. There's my picture. They give you that return. And there are many different types of exchange-traded funds. They're a basket of shares. They track the market. So, for example, you buy an exchange-traded fund on the top 40 index. They go and buy those 40 shares that make up the index. Put them into a basket, sell you the basket. Could you go and buy those 40 shares yourself? Yes. but you'd have 40 transaction fees. You buy the basket, 1 transaction fee. And ergo, you track the market. You can do small amounts from as little as 300 Rand per month or 1,000 Rand lump sum. So you can get into the market at really, really cheap rates. You don't need to be rich to get rich. In the olden days, if you wanted to be in the stock market, you needed to be rich. I mean, we're talking back in the sort of 70s, 80s. These days, we can start from 300. You can go to companies like Satrix. You can go to companies like ETFSA, run by Mike Brown, no relation, who is standing, he's actually standing there, but his stand is just over there on the entrance as you come in. What he enables you to do is to transact in those, to buy them on a monthly basis or on lump sums. And a quick look at those that are available. Too quick. We've got indices, so you can go and buy the top 40. You can go and say you want to get resource stocks, and you can get a resource ETF. You can get a mid-cap, you can get a property ETF. You can say that the future is oil, and you can go and buy an ETF that tracks the oil price. You can go and buy gold, platinum, silver, palladium. That lovely little gold block shouldn't be quite where it is, but underneath that is palladium and platinum. So we can get exposure directly to commodities. What we look for in a portfolio is what we call diversification. And we diversify 2 ways. In different assets, and within those assets we diversify. So the first thing we want to do is have some different assets, which would mean have some property, have some commodity. And then in the equity space, don't put all your money into one share. You put all your eggs in one basket, and you drop that basket, you're in trouble. So you get yourself an index ETF, you get a property one, you can get yourself a commodity or an energy one, and if we come to the next screen, we've even got agricultural and international. And then, of course, money markets, government bonds, currencies, and the like. So just with a very, very simple product, in a very, very cheap environment, in an online platform, via a stockbroker, or via a company such as ETFSA, or directly from a company such as Satrix, we can get exposure to pretty much everything. We can, if we think that Europe is not going to collapse in a heap. I did note yesterday they won the Nobel Peace Prize, which in itself was a little bit weird. But the bigger issue is the Nobel Peace Prize comes with a prize, $1.2 million US. So he gets the $1.2 million US. Because I mean, I'm happy to be European if need be. So we can build a complete, complicated, yet very, very simple, easy portfolio. As I said, from 300 Rand a month or 1,000 Rand lump sum. This is dipping our toe in the water. We can then get smarter and start moving to the online environment, the DIYs, opening accounts with online brokers and everything else. So I need to keep an eye on my time. Benefits of the stock market, long-term price growth. That comes back to that image I showed you earlier of the index. Over the long term, the stock market is the best performing asset class. Over the short term, it's about chaos. It can go down 3% in a day, up 2% in a day. In 2008, it was down 25% and change. Some stocks are still more than 60% below where they started 2008. Now that's particularly the platinum stocks. There are particular issues in the platinum sector. Other stocks, such as Shoprite, beginning of 2008 was 30 Rand. Yesterday it's 160 and change. Now Shoprite is probably one of the better examples I can pull out. SAB Mill is probably up 2 or 3-fold. So we've gone through that crisis, we're still in that crisis, and there are companies doing exceedingly well. This is where we create long-term wealth. We get dividends. Dividends are your share of the profit. You own a slice of Shoprite. Shoprite makes a profit. And how they make a profit is deadly easy. They buy baked beans, they buy huge quantities of baked beans, and they sell them at very, very small margin. They make 5 cents per tin of baked beans, but they sell millions of tins. And all those 5 cents start to add up, to the point where Shoprite does about 30 billion rand revenue every 6 months. When they make a profit, some of that profit they keep to grow the business, to open new stores, particularly into Africa in the case of Shoprite, to upgrade existing stores. But they also take some of that profit and they give it back to the owners of the business. That is me and you. That is the shareholders. We receive that as dividend. Twice a year, they will announce a dividend payment, and that is your slice of the profit. Now, if you've only invested 300 Rand, well, your dividend payment is going to be pro rata small. Might be $6. But it's that process. It's about starting, and over time, it grows. And if my next slide would be, I want to go to that slide, I'll come back to the rest. Now, as an example about the power of dividends. This happens to be dividends on Standard Bank. In 1991, you could have bought the share for around 2 Rand. And over the 20 years since then, you have received 25 Rand in dividends. The blue line is the dividend as it's paid every 6 months. And you can see right back there in 91, your dividend payment was tiny. And slowly it started to grow, where you're now receiving dividends of 2 Rand on a share that you only paid 2 Rand for. In other words, you get 100% of your money back every 6 months. The secret? 20 years. And is it different for other shares? Yes. We picked Standard Bank in this case. We could have picked many other stocks that were around 20 years ago. And if you'd put money into Standard Bank back in 1991, if you'd put 1,000 Rand, which make no mistake, 1,000 Rand back in those days was real money. Heck, you could buy something and you got change. But let's go back to 91. And I know what some of you are thinking. I wasn't even born in 91. Gotcha. But let's, for those of us who were around in 1991. 1,000 Rand, how did we get that? Well, we saved $100 a month for a year. At the end of the year, we took our 1,000 Rand and change. In fact, it would have been a bit more than 1,000. And we went and bought some Standard Bank shares. We would have got about 500 shares. Those 500 shares today are worth about 55,000. Because the shares are about $100 each. And your dividend that you receive is 2 Rand every 6 months. So you're getting 1,000 Rand every 6 months from Standard Bank. Is that enough to retire on? Well, if you're anything like me, not even close. But let's be honest, all you did was save $100 a month for a year and then you quit. In the second year, 1992, you saved another $100 every month. And at the end of 92, you bought another share, SAB Miller. And in 93, you did it again. You saved $100 a month and you bought another share. And after that, sort of by 2000, you've been doing this for a decade, you now have a portfolio of 10 stocks, each of them giving you dividends. And you're taking those dividends and using that money to buy more stocks. And after 20 years, in other words, fast forward back to today, you've created significant wealth for yourself. None of it rocket science, none of it massively hard, and let's be honest, not rich enough to go and buy Europe, but certainly rich enough to actually contemplate a good retirement, to contemplate fancy holidays, kids, education for your kids, and the like. And all you were doing was starting early and starting small. It is easy, particularly in the online environment. In many ways, perhaps it's become too easy these days. And what I mean by that is that the flow of information, what we need to do is be committed. We need to buy the quality, buy it at a good price, and then forget about the short-term chaos that happens. And it's very easy to stand here and tell you that. Trust me, when the short-term chaos is happening, when we're sitting in March 2009, when our stock market has collapsed 50%, when it looks like the world is going to end, it's not quite so easy then to do what we know to be right, which is ignore it. Markets will recover. They will crash, they will recover. The lots of information available is a good thing and a bad thing. When I started in the market, when I say started, not investing, I was living in Shishlui, we're going back to the early 80s. I was a kid, I was interested in the stock market. To get information was quite simple. I used to write a letter to the company. For the young kids, a letter, envelope, stamp, go Google it. I would write a letter to the company. They would then send me their annual report. By the time that annual report arrived in Shishlui on the north coast of KZN, it was history. It was maybe only 6 months out of date. Now I want an annual report. Click, click, there it is on the website. There was a company listed on the JSE. They put their annual report on the website at 12 o'clock yesterday, 12:30. I am reading it. And that is available to anyone with internet access. So that playing field has been completely leveled. The information is available. The problem then becomes too much information. What I call noise. And there is a ton of noise. There are 24/7 TV channels. There are 4, 5, 6 radio shows every single evening in Gauteng talking about the stock market. There are 2 weekly magazines, 2 daily newspapers, and a whole bunch more beyond. There are countless websites. If anything, these days, there is too much information. What am I saying by that? Not that we want less information, but it's not the core information. Reading an annual report, that's good information. It's all that colliery information. We've got to be selective. We've got to be careful that we don't get prodded into doing something we don't actually want to do. In other words, knee-jerk responses. That man on TV said whatever, I must follow him. Just because he's on TV doesn't mean we should follow him. Just because the person on TV likes a share doesn't mean you should buy it. What it does mean is you can start doing your homework on that particular share to see if it fits your requirement. And again, the homework is not rocket science. It's about common sense. It's about deconstructing and understanding a company's business model, which sounds complicated, but again, it isn't. We understand how banks work, how retailers work. The confusing ones, probably the insurers. Some of the IT companies, I never quite know what they're talking about. I suppose the bigger picture is that the secret to wealth is not going to be on a TV screen or in a print publication or a website. Yes, we can get information there. Broadly, we need to block that out. Typically, I say to folks, turn it off. With one exception. If I'm on TV, it's quality. You can turn off everybody else. So is it hard work? No. Is it work? Yes. Is there effort required? Yes. We could argue that this morning was hard work. I mean, I don't know. I had to wake up quite early on a Saturday. Now, I always wake up early on a Saturday. I make myself a coffee, I go back to bed. This morning, I made myself a coffee and got dressed. That was a bit of a shock to the system. A bit of effort required. I don't want to say it's hard work, but yes, effort. You want to buy shares, you want to go to ETFSA, you want to go to an online stockbroker, you're going to have to do FICA. You know, prove who you are, lock of your grandmother's hair, etc. Not hard work, but certainly some effort involved. Most of it, as I said, common sense. Problem, common sense, not so common. If it was rocket science, well then the rocket scientists would be rich and the rest of us would be poor. Are there things to learn? Yes. Do we have to know what a balance sheet is? Maybe. I mean, I kind of know. I only learned balance sheets. Balance sheets are the best stuff you've ever seen. So what do you got? A balance sheet is assets and liabilities, right? Assets are good things. They pay you money, you add them up. Liabilities are bad things. They cost you money, you add them up. They don't balance, right? So you stick a number in the bottom, now they balance. I would call that crookery, but apparently that is accountancy. No disrespect to the accountants in the audience. I was gobsmacked when I learned that. So they don't balance, I stick a random number and now they balance and it's a balance sheet. Got it. I understand. Research is easier than you think. Every single one of you is doing research right now. Every single one of you probably got here as a result of research. You saw an advert, you heard an announcement, you thought, sounds interesting, but I'm not convinced. You went to a website, you dug around, you found out more information. What were you doing? Research. You're now here this morning. What are you doing? Research. You're going to go chat to some of the brokers. What are you doing? Research. You're shopping at your local Woolies, and you notice that the queues are getting crazier and crazier, longer and longer. What are you doing? Research. Well, and then maybe your research says there's only one teller. Why are they getting rid of stock? The problem with long queues, I was trying to shop at Woolies last week. Queues so long, what do? Leave. So is long queues good? Maybe that's because there's only one teller. But if all the tellers are there, maybe there are people like me who leave it. We're doing research. Do you rush out and say, long queue, must buy Woolies? No, 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 no. You never buy on one piece of information. You build a preponderance of evidence. So you find out there are long queues at Woolies. You go to your online stockbroker and you see if they have a research report on Woolies. What does that say? Buy, sell or hold. You go and check what the consensus data is. Again, that will be with your online stockbroker. You start to build a case study. Is it going to take some time? Yes. Is it a full-time job? Not unless you want it to be. If you want it to be a full-time job, it absolutely can be. It certainly doesn't need to be. So we're doing the research already. It's not half as complicated as we think it is. Critical, and I go back to what I said up front, save, then spend. No one else is going to look after your future as well as you are. We have to take responsibility for it. We have to say, we want a quality future. We want to retire well. And that we are the only person who's going to make that happen. We can't hope to randomly one day win the lotto. Which brings me to my favorite statistic of all time. In 2005, in South Africa, more people were killed by donkeys than won 5 million rand on the lotto. Next time you are buying a lotto ticket, watch out for the donkey. That's all I'm saying. We have to take responsibility. We can't rely on the state. We can't rely on our companies that we, businesses that we work at, our jobs that we have. We can't rely on our children. They might remember that you changed the locks. We have to be in charge ourselves. We have to make sure that we are doing it. And we have to appreciate that wealth creation takes time. It is not going to happen in a hurry. But it absolutely can happen. We can create wealth. Whoever we are, wherever we are. We can do it. We have to give it that time to help it happen. We need to use that time. And if we're going to go the exchange traded fund, the ETF route, how much time? A couple of minutes a month. Maybe half an hour on a Saturday morning. Not early Saturday morning, like 10, 10:30. It's a good time. If you want to get more involved, you can spend 20 hours a week, you can spend 2 hours a week. That's the beauty of the market. It enables different people to engage it differently. It says, how do you want to engage the market? What are your requirements? What are you looking to get out of it? And each of you can do it differently so that it fits what you're looking for. And then at the end of the day, yes, we still want to have whatever it is. Jimmy Choo shoes, I went to the Jimmy Choo in Cape Town. I've never seen anything so scary in my entire life. A pair of shoes for 75,000 rand. Have you any idea how much wine that would buy? The point being, if you like Jimmy Choos, and you think shoes are the best thing out there, well, get a slice of the action. Go and buy AVI. They are a company listed on the stock market. They do fishing, but they also own Jimmy Choos in South Africa. They also own Spitz, which is the fancy shoe. Try that again. The fancy shoe. You know what I'm saying. The fancy shoe shop at Sandton. There we go. Got it out. I'll practice that for my 2 o'clock presentation. So we can get a slice. So when you go and buy a 75,000 rand pair of shoes, instead of buying wine, which would be the obvious thing, you get some of that money back in profits and ultimately in dividends. And then, perhaps the secret. Everybody says to me, well, okay, cool. What's the secret to wealth creation? What's the one thing that is going to set us apart? What is the golden rule? And I'm not a fan of secrets or holy grails or golden rules, but if there is one thing that differentiates success from failure, it is time. The more time you have, the easier it is. If you come to me and you say, I want to be rich by Wednesday, we can try. We can take your money and we can try. We will almost certainly fail. Because let's be honest, if I could do that, I would own Europe. And probably North America. I would just own everything by now. I've been watching the James Bond movies. I'm getting megalomania tendencies. I want to own the planet. Could you be rich by Wednesday? Of course. The odds of your being rich by Wednesday, the probability, 0. I mean, yes, there's a 0.0000001% chance. If you come to me and say, I want to be rich in 2030, easy as pie. Buy Satrix. Buy some today, buy some every month. When you get a bonus at the end of the year, take half the bonus, put it in Satrix. You get a salary increase at your job, take half your salary increase, put it in Satrix. What are you doing? You are giving up some stuff now for the future. The alternative is we spend it all now and we have no future. We've got to look after it. As I said, nobody else is. And the longer we have, the more time we have, the easier it is. I don't have kids, I have a niece and nephew. I don't buy them presents because they get more presents than I can count. They are respectively 4 and 2, sort of that and that. So I buy them shares every birthday, every Christmas, etc. I don't buy them shares, I buy them exchange-traded funds. Typically I buy them Satrix 40 or one of those. Are they going to be massively wealthy when they are 20? No. Are they going to be wealthier than any of their friends? Probably. They'll be able to buy a flat, maybe a car. Certainly they'll be able to pay their varsity fees. And the secret there, 20 years. The problem is simple. I can't give them the money when they're 20. Because they're 20. They'll spend it on sex, drugs, and rock and roll. I can't give them the money when they're 30 because somebody will marry them for their money. I can't give them the money when they're 40 because they'll have a midlife crisis and go and buy expensive shoes and motor cars. So I give it to them when they're 50. They're going to hate me, but they're going to be massively wealthy. Notwithstanding, I'll be about 100 then, so it won't be any problem. The point there is not my expert stock selection, because I'm not an expert stock selector. The point is, I'm buying them exchange-traded funds, and I'm giving it 20 plus years. That is the secret. Time, more than anything else. That, ladies and gents, is a question mark. You would never believe it, but honestly it is. That is a disclaimer, which is a whole bunch of legal stuff. Basically says, make money, it's yours. Lose money, no longer yours. And that is where you find me, simonbrown.co.za. I think I have some minutes left. There's probably someone waving at me about time, but I can't see them. I'll take questions if there are. Yes, sir.
What are ETNs?
ETNs, good question. So I've been talking about exchange-traded funds, ETFs. The question is, what is an ETN, an exchange-traded note? There is one small but key distinction. An exchange-traded fund, the company that issues that physically goes and buys the shares or whatever it is, the commodity, and holds them in a ring-fenced environment. An exchange-traded note, they do not have to buy the underlying shares or commodities. So what are you doing? You take counterparty risk. Standard Bank and Absa Bank, and I think it's only the two of them, issue exchange-traded notes. If that bank went bankrupt, your exchange-traded note would be worthless. Here's the point. If Absa or Standard Bank go bust, we've got bigger problems. We are queuing to get into Zimbabwe. The question is simple. Ask yourself, would you be prepared to have a bank account with Absa or Standard Bank? If the answer is yes, you're happy to buy the exchange-traded note. Another question. Yes, sir.
You're talking about time.
Yes.
Length of time. I've just recently seen things like binary options, which is very quick.
Okay, so the gentleman's asking about binary options, which is very quick, and when we're talking quick, minutes. Forget days, years, whatever, we're talking minutes. There we're moving very much into the trading space as distinct from investing. This morning I'm talking investing. Trading would be derivatives, binary options, single stock futures, commodity futures, warrants, options, and the like. A whole different kettle of fish. Two key points. You're buying shares, essentially, with borrowed money. Brilliant if it works, very, very horrible if it doesn't. The process is quite simple. Learn to walk first. Don't jump in to be a trader. Because jumping in to be a trader is not jumping in the deep end, it is being dropped in the middle of the Atlantic Ocean when you can't swim. Oh, and they let the great whites out at the same time. So there are derivative products out there. They're a great tool to use, but learn the other tools first. And then even so, when you've got the derivative expertise, keep it small relative to your big wealth. Have I got time for one more question? There was a gentleman or a lady at the back over there, somebody? Nope, they've decided they're not asking. I've got one more question. Somebody, anybody?
What is just one lap?
Just One Lap is my core business these days. We do free online videos and webcasts around investing and trading. So for people who want to learn more about the stock market, whether it's trading, ETFs, how to invest, how to value companies, etc., we do live webcasts, which you attend via the internet, and then we make those available via video for download for free. So for example, we had one on Thursday evening where we had a gentleman talking about small cap stocks. If you were unable to attend, you can log on to the website and download the videos. And a last question there. Yes, sir. The gentleman's asking technical analysis, fundamental analysis. Fundamental analysis is balance sheet, cash flow statement and the like. Technical analysis is looking at the chart and determining valuations from the chart. Which do you use? It is personal preference. In my trading space, I'm exclusively technical analysis. In my long-term investing, I'm exclusively fundamental analysis. In my mid-tier, which is I might hold stocks there for 3 or 4 or 5 years if they carry on going on, I use a blend of fundamentals and technicals. So again, personal preference for the individual. Okay, and the lady flashing me time has stopped flashing, which means my time is officially up. Ladies and gents, I'll leave it there. I leave you with 2 points. It is simple. You've got to take that responsibility. Nobody else is. Thank you very much for your time.